So I think one of the things that has been, I think in my mind, is this market rotation idea. This is the weight of the S&P 500 in two different parts of the market, the technology sector in red, and then the white one is basically looking at the energy plus the materials. And you can see we go through these cyclical rotation periods where technology is leading the way for a while, and energy and materials are lagging and becoming less and less relevant. And then we see a turn because, for dollars coming out of tech, they start coming back into energy and materials. And I would suspect that usually that comes back into when sentiment is also very extreme in both sides of this trade. And so that is certainly the case today in terms of how we see folks and the conventional thought that technology will keep leading the way. And that's certainly not my view. My view is, again, remember the phrase from Simzel, where the opportunity is. The opportunity likely is where there's lack of capital interest. You don't lack capital interest when you're 30, almost 40% of the index. It's all the way around. And just to point out something regarding, the potential for these types of rotation periods, I wanted to mention something regarding the Japanese yen and the yen carry trade idea. And if you think about it, the BOJ, it was basically looking to raise interest rates by 25 basis points, which the magnitude of the move we had, just because of 25 basis points, give you a sense of how messed up things are on the macro world. But outside of that, what is the difference between, for a carry trade standpoint of the BOJ raising interest rates by 25 basis points or the Federal Reserve actually cutting interest rates by 25 basis points? I think that's a fair assessment of the situation. In other words, if the Fed cut interest rates, does that mean we're going to see more turmoil coming from the yen carry trade? No, personally, I don't think that's the big story. I think usually the narrative likes, from the media, likes to focus on a few things that are usually not as important as the overall picture. To me, the overall picture is right in front of you. Is this shift of leadership caused by what people see as important market dynamics, but it really is the setting that we have currently for something more like a real increase in volatility moving forward. And so, to me, this is opportunity right in your screen and how to position moving forward. Anyways, let's go to the next chart. This chart is also important because the yellow line is showing gold prices, which we've been bullish on it for some time now, and gold prices are at record levels. And the other one is the blue line, which we have also been bullish for a long time, which is overall commodities. And this one is looking at an equal weighted index for, I believe it's Goldman Sachs that does this index. And you can see that they usually trend very closely, right? And so you had back in 2007, 2008, 2009, all that period, those two lines are very tightly close to each other. Even during the decline of gold prices after 2011 and that bear market we saw all the way to 2016 or so. And then we saw really in 2018 or so, gold prices begin to really rally ahead of the commodity prices. So we did see a leading indicator towards that, where the metal was telling you, well, inflation is probably going to go higher. Again, this is doing exactly the same. And I think, although I don't want to go too much in front of all this, and think too much ahead of what could potentially happen, but let's assume we do see a blue line or overall commodities actually catching up to gold prices again, as it tends to do historically. What would that do to the Federal Reserve's situation? It would make it very challenging because clearly we're seeing, deceleration, if not contraction, of growth in the U.S. already, economically speaking. And at the same time, inflation also accelerating to the upside. Well, that's called what we say stagflation. And this is what that environment does to you. And I think that we're probably likely to see something along those lines. What is going to be interesting from this is that the Fed is not going to be able, most likely, to act on that inflationary pressure coming back. And the main reason for this is because of something we wrote in our recent letter, but also we've been talking about this in this last presentations, which has to do with the interest payment relative to GDP right now, which is becoming very pronounced and probably should be, in my view, the most important actually indicator anybody should be paying attention to, because that's what's going to drive most likely policy making moving forward. Anyways, let's go to the next chart. And Kevin made a point, and I'm not going to go deep into this, but as you can see, if that's the setup where gold is leading the way, and at the same time you have hedge funds actually turning overly bearish, and if you look at this chart, every time we see an overly bearish environment, or I should say positioning from hedge funds in the commodity space, well, guess what? That's usually a turning point, a very key turning point. And are we in another one of those pivotal moments? And I think we are. I think there's very high potential that the commodity prices overall can actually also follow gold prices in the near future. Let's go to the next chart. Now, in this next chart, I'm showing just an example of the DBA in agricultural commodities. And you can see this. Why am I showing this? Is because food prices depend on this, right? Food prices are very impacted by agricultural commodities. In fact, if you think about the especially lower classes financially in the U.S. and other places in the world, they are really they can be actually really impacted by upper movement in agricultural commodities. And so, as you can see here, this ETF DBA is basically have surged recently, mostly caused by cocoa, if all of you remember, and then it crashed. And went from 26 all the way down to 23, as you can see there in the chart. And that 23 level was actually the prior peak of 2022, when we had the Russian invasion in Ukraine, in which caused most commodities to spike. So here we are now back to those levels, and that's creating a major support. And actually, this chart is slightly old; it's like 2 days old, because the green bar there did mark a bottom, and we've seen an upper movement and a strong move today in agricultural commodities. Let's go to the next chart. This is just me circling now the two areas just to make sure you all can see that important area where this chart has been bottoming. If we go to the next chart, you can see another interesting aspect, which I think is just as relevant as the prior charts, is the allocation across family offices. So I was showing, that leadership. First chart was showing the leadership of technology versus resource-related sectors, and this chart, I guess, shows why we're seeing this. And if you look at the section that shows commodities, and you can pause this video and look at your own time, you will see that it's a very small amount. So basically, you're seeing three circles. One is family offices of 50 million to 500 million. Another one is from 500 to $1 billion. And the other one is $1 billion above. And all of those show that they have ultra low commodities allocation today. And so relative, especially to overall equities and fixed income and others. And so, capital at some point flows back into things that have been neglected for a long time. And this is probably going to be the case here. So it is important to be finding these types of supporting data points that certainly, I would say, add to the commodity thesis. Let's go to the next chart. On the next chart, you can see two things: the balance sheet of the Fed, and secondly, you can also see the 2-year yield at the bottom. The 2-year yield has been dropping. We've talked about the idea of T-bills and chill, although 2-year yields are not T-bills. T-bills are a little shorter duration than that. But you can see that they tend to move very closely as the Fed starts seeing the percentage or the implied probability here of the Fed actually cutting interest rates should be reflected on the decline of the white line. The point of the chart is to show that when you see a real downward movement in the 2-year yield, you also tend to see the Fed balance sheet to start to rise. And I think Quinton made a point recently internally that he realized that the green line in this chart, in this case, the balance sheet of the Fed, has been leveling off. It was declining in a trend that was much faster than the prior months, and recently has been showing some signs of bottoming, perhaps. And it wouldn't be too surprising to see actually that reversing in a big way, as we see usually when the 2-year yield falls, and that actually coincides with a recession as well. So, this is an important aspect because it adds to the prior points of tangible assets, particularly when you have, imagine actually seeing the green line rising in a period where commodity prices are also already accelerating for their own reasons. And so, this could add more, I guess, fuel to the fire of inflation overall. Let's go to the next chart. On the next chart now, it's just an idea of listening to the bond market and not to the equity market a lot of times. And this is just what the bond market is telling us regarding where the Fed interest rate it will be in the next 12 months. And this is the most implied cuts that we've seen all the way back to the 80s, if you looked at this chart, or I should say all the way back to the global financial crisis. But really, if you see the dashed line, you can see clearly that all the times we've seen that the bond market speaking this loudly, we actually had a recession. So indeed, the bond market was right. And what we end up seeing was that equity markets had to correct and to adjust and reprice according to what the bond market was alarming. And this is certainly the case here once again. And so, especially at a time when we have a few days like recently when volatility spiked and people still think this is just a unique event and we're going to go back to normal. But the real problem is that those issues, when volatility spikes the way it did, it just really breaks the credibility and stability of the market in a large way. It makes people behave differently, especially when it considers hedging for a portfolio and other aspects of money management. And so that certainly was that confidence was broken, in my view, back in Monday of and it's been breaking recently actually, but more with more authority. I think that movement happened in Monday is something, not that we're going to see more days like that, but certainly that we're probably going to see volatility staying higher for longer. And there are a lot of instruments that are just not reflecting that world just yet. And that makes sense because if you remember the chart that shows the Fed funds rate, when we have a hiking cycle, there's a lagging effect on volatility. There's also a lagging effect on the cost of capital that it rises at some point in corporations, because as the Fed leads that movement on the policy side, at some point companies just start actually having to reissue their debt or roll their debt, and then taking on higher interest rates and therefore squeezing their margins. And so you do tend to see the increase of volatility with a lagging effect. But remember, we've been in a hiking cycle already for some time now. We're already at the point where we should be seeing that volatility spike, which already happened recently. But I do think that it's here to stay. It's not just a unique event. Let's go to the next chart. On the next chart now, you're looking at another type of rotation, which, if you research, and this, I guess this chart is a great analysis for this, supporting the view that when people say that we're going to see a rotation out of the mega caps in a very peaceful manner, and we're going to just rotate back into other sectors and everything is going to be fine. Unfortunately, history does not agree at all with that view. And this chart is great because it goes back to the 1900s. And it shows when you have this large percentage weighting of most of the large companies and they start to rebalance. In other words, they start to fall relative to the overall market. That tends to happen in a very nasty manner. And I think that's going to happen again. I mean, if you look at this chart right now, we're at the same level we were at the very peak of the 1929. This is kind of a scary chart. But certainly, you should add to your views about what would that cause to volatility, what would that cause to credit spreads, and all sorts of things that can still move and be the next dominoes to fall. Let's go to the next chart. Another way to see this as well is the number of times people or companies have mentioned the word Fed or Federal Reserve or any term that refers to the Federal Reserve overall, or the monetary authority here in the US. And you can see here, this is by far the largest. And probably another reason where interest rate policy is starting to become a problem and a challenge for most companies. And remember the duration of the debt on the corporate side. A lot of that debt is going to be coming due here soon, and so those companies are starting to actually having to reissue their debt and actually look at how to restructure their balance sheets. And those issues are, I think, very significant and will again add to the volatility profile of the overall market. Let's go to the next chart. Buffett actually sold, his about half of his Apple shares or position. And at the same time, as you can see here, he's sitting in about 1/4 of $1 trillion in cash or cash equivalents. Now talk about T-bill and chill. That is the definition of T-billing and chilling. So, if this is, a lot of people talk about Warren Buffett as being a great, perhaps a great value investor. There's no, I guess, argument against that. But to me, he's actually one of the smartest macro guys I've seen. I can only imagine, sitting back and relaxing with 1/4 of $1 trillion in cash, waiting to deploy at the right time. What a genius move. And a lot of people are seeing this, and saying, well, we've seen the number of his cash position being at record levels for some time now. But come on, just look at the chart. You can see the massive spike that we're seeing relative to any other year. This is definitely unique. If you're not seeing this as a signal, you're probably going to get caught up, just like most retail investors, unfortunately, that tend to hold the bag at the end of the day. Let's go to the next chart. Almost done. A saturation of the market is seen as well when you look at the foreign holdings of U.S. equities. And you have to ask yourself, where's capital going to come from? We're going to have to do a lot of QE to really, feed the need of these inflated valuations. That is, and by the way, this is normal. Every few decades, we have leadership coming from U.S. markets and then switches to emerging markets and the rest of the world. And so that valuation differential is normal. It tends to last a few decades. And guess what? We've had probably the most pronounced period of U.S. equities outperformance relative to the rest of the world maybe in history. If it's not history, it's close to it. And I said it before, I think a lot of that has to do with fiscal spending in the U.S. versus other places in the world. A lot of that has to do with the global reserve currency, allowing the government to spend more than other places. And you have to also ask yourself, is that something that is sustainable? Especially when you have interest payments really becoming a large percentage of overall government spending, more than 50% now. And so I think that that's eating, the government's capabilities of actually generating growth through fiscal and disciplinary policies, which are also unsustainable at some point. You can only do that for so long. And we've been doing this for a very long time. As I said, in average, since 2008, we actually spent about 8% of GDP on fiscal deficit. So, it is a very significant number. I don't think we've ever seen anything like this in history outside of war periods. And so, nonetheless, let's go to the next chart. And so you can see here when VIX spiked recently, and there are some, Kevin's right, there's a lot of folks calling out for the technicality issues of this, high prints in the VIX. And by the way, this one that I'm showing in the screen, it does not use that crazy VIX number that went all the way to 70 or so. However, as you can see here, there are other things that tend to actually spike when you see this red line spiking. And one of them is a junk spread. So, if you think about it, when companies with a very low or poor credit rating, as we see more volatility in markets, you should also see more volatility in terms of the cost of debt of those companies. And that is something that has just not happened yet. And the widening of spreads is something that, as you can see in this chart, it happens every time we see some sort of downturn. And so if I would suspect, I would say that the junk bond market looks very fragile. And I would say that there is a very, very strong possibility that you're seeing the yield curve movement. If you throw the yield curve in this chart, it looks just like it, meaning the yield curve is already also positioning that the junk spreads are also going to spike. So our biggest risk is actually access for capital in the next 12 months or so. If there is an environment like I'm showing in the screen of a spike of widening in spreads, yeah, it's going to be difficult, unfortunately, to for companies that are highly levered. Let's go to the next chart. And you can see another way of playing this, and we did this in our funds as well. But you can see that this is basically looking at implied volatility of the S&P. So for those who don't know, what is the VIX? The VIX is looking at the 1 month implied volatility of the put option in SPY ETF. And you can see here in this chart that you're looking at the differential between that versus the also implied volatility of the HYG puts. HYG is the ETF for junk bonds. So this is basically showing you how cheap putting a hedge on junk bonds in if there is a downturn in junk bonds, how cheap that is relative to the hedge in the S&P 500. And so this is a very interesting, setup for those investors that are looking for a hedge. And I do think that that's probably going to be the fact that the white line, should say the light blue line, is probably going to be moving the other direction. Probably likely to be moving higher, not lower anymore, because it's already at basically record levels. And so something I'm probably not going to get much cheaper than what it is right now. So it's good timing, in my view, to be adding to that exposure.